Welcome to this quick training on how to accept resale and exemption certificates in good faith under Texas sales and use tax laws. If your business sells to other businesses and doesn't always collect tax, this video is for you. Before we get started, a quick introduction. We're Brown Goertz Co, a state tax advisory firm that represents businesses in Texas sales and use tax audits with the Texas Comptroller. In these videos, we break down how audits actually work, where problems tend to arise, and what business owners should be paying attention to. The Texas Comptroller does not require that you police your customers and confirm the validity of their certificate. What the Comptroller does ask of you is that you follow the good faith rules when accepting certificates from your customers. Good faith is something you can rely on in an audit if you end up with a certificate that turns out to be invalid. Here's the reality. Sometimes a customer will give you a resale or exemption certificate that they shouldn't. It happens. And the Comptroller does not require you to verify every certificate. That's exactly why the good faith rules exist. Good faith is simply a set of rules that if you follow them when accepting a certificate, you are not held responsible for tax on that exempt sale, even if the certificate later turns out to be invalid. There are 5 rules that make up good faith. You must obtain the certificate at the time of the sale or at the beginning of the customer relationship. For repeat customers, you do not need a new certificate every time that customer comes in. You can keep a blanket certificate on file. For example, if a local repair shop buys parts from you regularly and they've given you a resale certificate, you only need to get that certificate once, not every time they walk in the door. The certificate must be complete, no blanks. If it's missing a phone number, a date, anything, the auditor can deny it, and you lose your ability to claim good faith. For resale certificates specifically, the taxpayer number must be 11 digits and start with a 1 or a 3. You are not required to verify the permit, just confirm it meets those 2 criteria. On the resale certificate, there is a section where the purchaser fills in what kind of business they are. Rule number 4 requires you to pay attention to the purchaser's business. It needs to make sense that they would be reselling what they're buying from you. To give you an example, I was representing a jewelry store in an audit. They had accepted a resale certificate from a motorcycle shop on the purchase of a $25,000 diamond ring. The owner of the motorcycle shop buys a $25,000 diamond ring, and he gives the jeweler the motorcycle shop's resale certificate so that he can avoid paying tax on the ring. The jeweler accepts the certificate because he's unaware of the good faith rule. Along comes an audit, and the auditor denies the certificate, and the jeweler is left owing the tax on the sale of that ring, because it doesn't make sense that a motorcycle shop would resell a diamond ring. And the final rule for good faith: all certificates must be on file at the time the audit begins, and on file means they are in the auditor's possession. Remember rule number 1? You should be getting the certificate at the time of the sale or at the beginning of the relationship. Well, sometimes, for whatever reason, that doesn't happen. And here's the tough part. Audits go back 4 years. If you sold to someone 4 years ago and you didn't get the certificate at the time, and now that person has moved, they've gone out of business, or even died, you may not be able to get it. And if you can't get it, you can't support the exemption, and the auditor will hold you responsible for the tax due on that sale. So it is really, really, really important to collect certificates at the time of the sale or the beginning of the relationship and have a very solid document retention policy. The key is this. By the time the audit officially starts, that certificate can't just be sitting in a file folder somewhere in your office. It has to be in the auditor's possession on day 1. That means provided to the auditor, whether in person or electronically, because if it hasn't been given to the auditor when the audit begins, it's treated as not on file. And at that point, you do not have a good faith argument. And just to be clear, there are documents your customer may try to give you that are not valid documentation for exemption. 501 C3 letters from the IRS, W-9s, 1099s, or exemption letters from the Comptroller, so don't accept these from your customer. Before we wrap up, I want to mention that we've created a downloadable reference guide on the good faith rules for certificates in Texas sales and use tax audits. It's designed as a quick reminder of the rules and common pitfalls. The link is in the description below if you'd like to download it. Thank you for watching. I hope this was helpful and gave you a little more clarity around how Texas sales and use tax audits actually work. If you have questions Or if you'd like to talk through your specific situation, our contact information is in the description below. And if you've received an audit notice, you're currently under audit, or your audit has recently concluded, feel free to reach out. We're always happy to take a look and let you know if we can help. If this information has been helpful, please consider hitting the like button, subscribing to the channel, and turning on the notification bell so you don't miss future videos. We regularly share practical guidance on Texas sales and use tax audits and issues that can have a real financial impact on your business. And if you know someone who might benefit from this information, please consider sharing it with them.